Hi, in this video, I'm going to be talking about time frame analysis and why traders use time frame analysis when analyzing the Forex markets. Now, time frame analysis is a concept where traders use multiple time frames to help them trade. So they will use two or more time frames, and one of those will usually be a higher time frame. And when I say a higher time frame, I'm talking about the daily, weekly, or monthly time frames, and that will be used as their guide, as the dominant time frame. So if the trend is up on the daily time frame, then they will have that bias on the lower time frame. And it's the same thing, for example, with support and resistance, or even indicators. For example, they will use the higher time frame, support and resistance levels or indicators, and then try to get more precision in their trading when trading the lower time frame, which is the second time frame or their third time frame, and look for entries on lower time frames. So why do traders use the higher time frame to guide them in their direction? And it's really because the higher time frame, if you think about the daily time frame, there would be 24 hours of trading, which is more significant than an hour of trading. There is way more volume and way more supply and demand that goes through 24 hours of trading than on a 5 or 10 or 15 minute time frame chart. So traders will look to the strongest levels of supply and demand, and basically base their trading decisions on the higher time frame. So another reason why traders will use the higher time frame but use the lower time frame for precision is really because of the risk and the amount of pips that you would have to risk. So let me walk you through an example and the process of what I'm talking about. And we're an Australian dollar US dollar currency pair. So we have a level of move this out of the way. We have a level of support and resistance here, right? So we've got level here, prices come up, so we've got resistance a few times, barely touches, and we've got another one there, a few times here, then prices break through, and then prices come down here. So what traders will do is they will look at this area of support and resistance on the daily and see if they can get in around here, for example, on the lower time frame. So rather than risking, let's say for example that was an engulfing candlestick pattern, a bullish engulfing candle pattern, and if you want to know why that's an engulfing pattern and why traders do buy, then you can watch the video on candlestick formations, which we have on the website. But if traders are trading the daily time frame chart, they'd have to risk at least 117 if they put their stop loss, right under the second candle or the first candle in the sequence. Then it'd be about 120 pips. Whereas if traders are looking to buy on the hourly chart, so as prices come down into this zone on the daily chart, they would look to an hourly chart on the above chart and look for an entry here. So this is where they get maybe a bullish pin bar right here, and then they would have only they entered on the close of that candle, possibly maybe something like 15 pips risk. So rather than risking 120 pips, they would risk about 20 pips on the hourly. So using the daily time frame for their major levels for support and resistance, and also the hourly for the precision entry. Another way that traders will use the multi-time frame analysis is to tell them what way the trend is going. So if we look at the hourly chart, right, and the market, actually let's zoom in. So if we look at this, right, traders would have probably been looking at the market making lower highs and lower lows. So you've got a low, you've got a lower high now, and the market is steadily stair-stepping down into a level of support. Now, if you were using a single time frame, you may not be aware that the overall and the higher time frame was actually from here, and it was just pulling back overall. So this period here between, let's change the color to, let's say, orange, right? So you've got a period between here and here on the hourly, but on the daily, this is exactly what the period was. It was right here. Now that was just a pullback, and if you were trading the overall trend, then you can see from the daily we have higher highs and higher lows being made slowly. So let me draw this out. There, down. And you can see that the market on the daily has been making higher highs and higher lows. So it's no surprise now to see when the market comes back into a level of previous resistance, and aggressive traders will look to enter long at this level. And again, rather than risking 100 odd pips, they would be risking 20 or so pips, and rather than being caught out, trading on the wrong side of the market and the overall higher time frame, which is a more powerful chart, they may have stayed out of all of this and looked for their entry here and then bought at this area here. So higher time frame and multi-time frame analysis is really just looking at the higher time frame, and if you are trading the daily, then you would look at something like the weekly or the monthly chart. So so you would look at the weekly or the monthly chart, and if you were trading, for example, the 5-minute chart, you may look at something like the hourly or the 4-hourly. But the whole concept of trading multi-time frame analysis is just to give you a broader perspective on what the market is doing, and just always remember that the higher time frames like the daily and the weekly and the monthly are more powerful than the lower time frames. Support and resistance on the lower time frames, there tends to be a lot of chop, and levels tend to spike through and not necessarily hold as much, whereas the daily, weekly and monthly time frames are a lot more significant. There's a lot more supply and demand going through these levels. So when you have an engulfing candle or a pin bar candle or any kind of reversal signal like a double top or double bottom on a higher time frame like the daily, they are definitely more significant than a 5-minute entry signal. So I hope that helps. And if you have any questions, just email me at info@trading180.com.